These five stocks I'm going to cover in this video could potentially beat the market in 2025, and I personally own 2 out of 5 of these stocks. Starting off with Alibaba, which is a huge Chinese company that runs e-commerce platforms like Taobao, which is like eBay, Tmall, which is like Amazon, and Alibaba.com, which is a wholesale trade. It also offers cloud services, digital payments, Alipay, and logistics, Kenyao. Founded by Jack Ma in 1999, it connects businesses and consumers worldwide. Now, the reason I find the company interesting is that at the moment there's a lot of geopolitical concerns and Chinese government concerns. Now, the geopolitical concerns is a real concern, as if the Chinese economy gets a big hit, then Alibaba is also going to take a hit. But if we look at this chart right here, we can see that most of China's revenue comes from inside China and Asia, which means most of the concerns is around Europe and America and other markets, which makes up 17% of Alibaba's total revenue around the world. And this is mainly due to their e commerce business. Now, it does seem like the geopolitical concerns are not that much of a danger to Alibaba. Of course, it is if their revenue from Europe, America, and other markets drop in half, but I don't think it's something that they can't recover from. And there's also a possibility that the market has overreacted to these concerns, making Alibaba look cheap. If we then look at the overall business, the fundamentals are looking decent, with a return on investment capital of around 8%, and that is a great upside compared to the 5-year average return on investment capital of 6.9%. And the sector median return on investment capital is around 6.2%. So Alibaba does have a great return on investment capital. Now, their trailing 12-month gross margin is 39%, and their net profit margin is 9%, and their free cash flow margin is 10.7%. So then if we look at some of Alibaba's big competitors, such as JD.com, they have a gross margin of 10%, a net profit margin of 3%, and a free cash flow margin of 3%. So Alibaba is looking good as well when it comes to their free cash flow margin, gross margin, and profit margin. Lastly, the valuation for Alibaba is looking relatively cheap, as I have a trailing 12-month price to earnings ratio of 18 and a trailing 12-month price to free cash flow ratio of just 14.75. So Alibaba is looking very interesting. Next up is ASML, which I personally own within my portfolio. Now, this stock is very interesting because 2024 has been a big investment year for them, and they have said that it is going to pay off within the next few years, which is why the company does look a bit expensive according to price to free cash flow ratio, as the company have a price to free cash flow ratio of 94. There has also been a slowing demand for chips within the PC, automotive, and mobile sector, which is expected to recover here in the next few years because of potential lower interest rates. But one thing that I find interesting is ASML's new high-end machines that is starting to get delivered to their customers. And this machine is expected to make way more transistors on the chips, which will make the chips faster and more efficient. Now, where it becomes interesting is that the machines is expected to keep Moore's law alive, and the Moore's law states that every 2 years transistors double on a chip, and this has become difficult over the past few years, as there is a physical limit to how small transistors can become. Now, the high-end A machines can really change the game for ASML customers, which increases demand for ASML products, resulting in more money for ASML. And given that ASML has a wide moat and a lot of pricing power, they are going to have a really good margins on this new machine. So ASML is very interesting to keep an eye on here in 2025. The next company is Lululemon, and the reason I find this stock worth to keep an eye on in 2025 is because they are looking way better than their competitors when it comes to fundamentals, as the company have a return on investment capital of 36.4%, and it is a little bit down from their 5-year average return on investment capital of 42.5%, but this is because of macroeconomic conditions, so basically inflation. Then they have been investing heavily into store expansions, enhancing their digital platforms, and increasing their inventory to meet growing demand. Also, they have seen slowing revenue growth, but if the company can successfully operate and expand their product line, also seeing more rise in demand from the men's side, which is a huge market, and focusing more on international sales, then the company could see some serious growth, as they don't hold that big of a portion of the overall industry's market share. But if we compare them to their competitors such as Nike, Lulu could look expensive. Now, Lulu does have great fundamentals compared to Nike, such as better margins and return on investment capital, also more growth potential because Lulu is way smaller than Nike, but Nike still has a trailing 12-month price to earnings ratio of 22 and a price to free cash flow ratio of 16, which is cheap compared to Lulu's price to earnings ratio of 29 and price to free cash flow ratio of 30, which is due to their sudden rise in stock price. So overall, Lulu could be a very interesting stock here in 2025 if they get cheaper. If not, Nike might also be an interesting stock to watch. Next up is Google, which is the second stock out of these five that I have in my portfolio. And Google is a really interesting case. Now, I don't really think I need to explain Google other than it is an excellent company with great fundamentals and a moat. But the interesting thing about Google is their way of innovating and continuing to grow. As recently, they have been heavily investing into their cloud business, which have paid off recently, as now it is profitable while growing rapidly and competing with their competitors. But the heavy investments have affected their price to free cash flow ratio of 40. So before you say it is an extremely expensive company, you have to look at the capital expenditures. Now, the price to earnings ratio is looking okay at 23, but the reason I find Google interesting here in 2025 is because of their AI products, as they can both help their consumers with better search engines, such as the Gemini 2.0, but AI can also help the overall business, making things more cost efficient, which increases margins and helps Google become more profitable. Now, I'm also just interested in the overall business, as it is a cash cow generating lots of cash, meaning it can return value to shareholders through share buybacks and dividends. Now, the last stock is Crux, and the reason I find Crux interesting is because the company have seen a slowdown in revenue growth. But there's a reason behind this, because they recently acquired a company in 2022 for $2 billion called HeyDude, and this hasn't been going as expected because the company's revenue is still declining after the acquisition. But the interesting part is that the main brand Crux is doing okay and is still growing revenue with high single digits to low double digits growth. For example, here in the third quarter of 2024, the HeyDude brand revenue declined 17% year over year, while the Crocs brand revenue increased 8% year over year. So if Crocs can turn this HeyDude brand around, and don't get me wrong, this is difficult, they can start seeing some serious growth in the business again. So I'm definitely going to follow Crocs in 2025 as the business is selling at a very cheap valuation with a price to earnings ratio of 8 and a price to free cash flow ratio of 6.86. And the business has a 5-year return on investment capital of 42%, which is really incredible. But the current return on investment capital is 24%, which could be because of the HeyDude brand, though it has been increasing these past few quarters. Also, Crocs have really good margins, as their gross margin is 58% and their profit margin is 20.5%, and lastly, their free cash flow margin is 23%. So Crocs could be an interesting stock to watch here in 2025. Thank you so much for watching. Now, if you want to learn more about the two widest mode companies ever, Google and ASML, watch these videos where I make a deep dive into the companies.